There's a stretch of water 21 miles wide. 21 miles. You could drive that in less than 30 minutes on a highway. And if that stretch of water gets blocked, your gas prices spike, your grocery bill explodes, your 401k takes a hit, and the US government's debt problem gets dramatically worse. All from 21 miles of ocean. That's the Strait of Hormuz. And right now, it's at the center of the most dangerous economic flashpoint on the planet. Most people are watching this story through a geopolitical lens: missiles, military, Iran versus the US. But I want to show you something different. I want to show you the economic blast radius. What actually happens to your life, your wallet, your job, your savings if the Strait of Hormuz closes? Because the people in power already know the answer to that question. The real question is, do you? Let's start with the basics, because most news coverage skips right past them. The Strait of Hormuz is a narrow waterway sitting between Iran to the north and Oman, and the UAE to the south. It connects the Persian Gulf to the open ocean. And through that 21-mile choke point flows approximately 20 to 30% of the world's oil supply every single day. Saudi Arabia, Iraq, Kuwait, UAE, Qatar, all of their oil exports pass through this single channel. There is no easy alternative route. There are some pipelines that bypass Hormuz, but they carry a fraction of the volume. If Hormuz closes, the world doesn't just slow down, it seizes up. Now here's what makes this moment different from past tensions in the region. This time, the United States has directly struck Iranian territory, and Iran has explicitly threatened to close the strait in retaliation. This isn't saber rattling. This is the most serious Hormuz threat in decades. So let's walk through exactly what happens if they follow through. The last time the world experienced a serious oil supply shock was 1973, the Arab oil embargo. Gas lines stretched around city blocks. The US economy went into stagflation, that brutal combination of high inflation and stagnant growth that took nearly a decade to resolve. That embargo cut off about 7% of global oil supply. Hormuz carries 20 to 30%. Let that sink in. We are talking about a supply shock roughly 3 to 4 times larger than the one that paralyzed the American economy in the 1970s. What does that mean in practical terms? Oil prices don't just rise, they surge. Analysts who model these scenarios talk about oil hitting $130, $150, potentially $200 a barrel in a sustained closure scenario. Gas prices at the pump spike fast. We're talking potentially $6, $7, $8 a gallon nationally. Not in California. Nationally. Diesel spikes even harder, and diesel is what moves everything. Trucks, freight, the entire supply chain that puts goods on store shelves. When diesel prices surge, the cost of everything surges with it. Airlines get crushed. Jet fuel is a direct derivative of oil. Ticket prices explode. Some carriers start cutting routes. And then it bleeds into the broader economy. Manufacturing costs rise. Shipping costs rise. Every business that uses energy, which is every business, starts passing those costs on to consumers. This is called a supply shock. And supply shocks are the one type of inflation that the Federal Reserve genuinely cannot fix by raising interest rates, because the problem isn't too much demand. It's not enough supply. Raising rates slows the economy, but doesn't put a single barrel of oil back on the water. Here's the part that almost nobody in mainstream financial media is covering, and it might actually be more dangerous than the oil shock. Fertilizer. Specifically, urea and ammonia, the two primary inputs in nitrogen-based fertilizers that grow the food that feeds the world. The Middle East, the region that would be directly destabilized by a Hormuz closure, produces approximately 20 to 30% of the world's urea and 25 to 30% of global ammonia. For those who don't follow agricultural commodities, this is enormous. Nitrogen fertilizer isn't optional in modern agriculture. Without it, crop yields collapse. A 30% drop in fertilizer availability doesn't mean 30% less food. It means potentially 50 to 60% less food production in fertilizer-dependent regions. Now think about the timing. Planting seasons don't wait for geopolitical crises to resolve. If fertilizer supply is disrupted now, harvest shortfalls show up 6 months to a year from now. By the time most people feel it at the grocery store, the window to prevent it has already closed. Corn prices rise, wheat prices rise, soybean prices rise, and everything that uses corn, wheat, and soybeans, which is most processed food, most meat, because livestock eat grain, most of what's in your grocery cart rises with it. We could be looking at a simultaneous energy shock and food shock. The last time that happened in combination was the 1970s, and it reshaped the global economy for a generation. Now here's where it gets really uncomfortable. The United States government is currently running a deficit of over $1.8 trillion per year. The national debt has crossed $34 trillion. Interest payments on that debt are now the single largest line item in the federal budget, exceeding defense spending. And every time oil prices spike, that problem gets worse. Not metaphorically worse, mathematically, mechanically, measurably worse. Here's why. When oil prices rise globally, the dollar tends to strengthen in the short term because oil is priced in dollars, so global demand for dollars increases. That sounds good until you realize what a strong dollar does. It makes US exports more expensive, hurts American manufacturers competing globally, and puts pressure on emerging market economies that have borrowed in dollars but earn in their local currency. Meanwhile, the higher inflation that comes from an oil shock forces the Federal Reserve into an impossible position. Do you raise rates to fight inflation and risk crashing an already over-leveraged stock market and real estate market? Or do you hold rates steady and let inflation run, destroying the purchasing power of every American who holds dollars? There is no clean answer. There is no good option. There is only the question of which crisis you want to have first. And this is exactly why the people who study these systems, the ones sitting at the top of the financial pyramid, are already positioning. Already hedged, already on the right side of what's coming. The question is whether you are. Here's where the story gets interesting. Think about what I just described. A US military strike on Iran. Iran threatens to close Hormuz. 20 to 30% of global oil supply at risk, inflation potentially roaring back, the American economy under severe stress. Would the President of the United States not understand these consequences? Of course he would. So why do it? The answer, I believe, lies in Venezuela. Venezuela holds the largest proven oil reserves on the planet, larger than Saudi Arabia, larger than the entire Middle East combined. And the Trump administration recently arrested Venezuelan President Nicolas Maduro. Connect the dots. If Hormuz closes and Middle Eastern oil becomes inaccessible, the world needs an alternative. And suddenly, whoever controls Venezuelan oil becomes the most important energy supplier on Earth. This isn't foreign policy for the sake of democracy. This is a resource play on a generational scale. Trump isn't being reckless. He's repositioning American energy dominance away from a region that has always been one war, away from catastrophe, and toward a hemisphere that the United States has historically considered its own backyard. Whether you agree with the strategy or not, understanding it changes everything about how you interpret what's happening right now. Let me give you the full picture of what a sustained Hormuz closure actually looks like for the American economy. Energy. Gas at the pump hits levels most Americans have never seen. Home heating costs spike going into winter. Utility bills climb. Every cost tied to energy, which is every cost, inflates simultaneously. Food. Fertilizer shortages work their way through the agricultural supply chain. Grocery prices, which already feel impossibly high to most Americans, climb further. Lower-income households, who spend a disproportionate share of income on food and gas, get hit hardest. Financial markets. Oil shocks historically correlate with stock market drawdowns. The last major oil shock before a recession was 2008. The one before that was 2000. The one before that was the early 1990s Gulf War. Every major oil disruption in modern history has preceded or accompanied a serious market correction. The Federal Reserve faces a stagflation scenario with few good options. Rate cuts would add fuel to inflation. Rate hikes would crash credit markets. The middle path, holding steady and hoping the shock is brief, only works if the closure is brief. Which, in a full-scale US-Iran conflict, it may not be. The US dollar. Short-term strength, long-term questions. If this crisis accelerates the global conversation about dollar alternatives, and it will the long-term trajectory of dollar dominance gets murkier. I'm not here to panic you. Panic is the enemy of clear thinking. But I'm here to give you an honest picture so you can make informed decisions. Here's how I'm thinking about this. 1. Energy exposure. If you're not holding any assets that benefit from rising oil prices, energy stocks, energy ETFs, commodity positions, you are entirely exposed to the downside of an oil shock with no offset. That's a choice. Make sure it's a conscious one. 2. Food and agriculture. Agricultural commodity prices and agriculture-related equities tend to perform well during supply disruptions. This is not a new idea. It's what informed investors did in 2008. In 2022, after the Russia-Ukraine conflict hit fertilizer markets, and it's relevant again now. 3. Dollar diversification. I've said this before and I'll say it again. Holding 100% of your savings in a single currency is a risk. Not because the dollar is going to zero, it isn't, not anytime soon. But because currency diversification is basic risk management that most Americans completely ignore until it's too late. 4. Cash and liquidity. In any serious market dislocation, cash is king temporarily. Having liquidity means you can make decisions from a position of strength instead of desperation. The people who got destroyed in 2008 weren't just the ones who were over-leveraged. They were the ones who had no liquidity and were forced to sell at the worst possible moment. 5. Think in systems, not headlines. The news will tell you about missiles and military movements. What it won't tell you is the fertilizer supply chain story, or the Venezuela play, or the Federal Reserve's impossible position. You have to connect those dots yourself. That's the actual skill that separates people who navigate these moments from people who get caught by them. 21 miles of water. That's all that stands between the current global economic order and a supply shock that would reshape everything: energy prices, food prices, financial markets, the dollar itself. The people who understand this are already positioned. The people who don't are going to spend the next 12 to 24 months wondering why everything got so much more expensive, why their portfolio is struggling, why the economic recovery everyone was promised keeps getting pushed back. You now understand what's at stake. What you do with that understanding is up to you. If this video gave you a clearer picture of what's actually happening, share it. The most valuable thing in a crisis isn't gold or stocks or cryptocurrency. It's an accurate map of reality. I'll see you in the next one.